Okay, let's unpack this. Have you ever sort of felt like there's this secret playbook the ultra wealthy use for their money, especially, around tax time? It really does seem like a different financial world sometimes. So today, we're doing a deep dive into exactly that. How wealthy individuals and even huge corporations legally manage to pay less tax. Sometimes, well, sometimes none at all. We're going to look behind the curtain at the strategies, the trends, and this whole kind of sophisticated industry that helps make it happen using the material we've gathered. Right, so our mission here is just to give you a really clear picture of how these often very complex systems work. Think of it as a shortcut to getting informed without getting lost in all the jargon. We're just trying to understand how it works based on our sources, not judging, not endorsing, just understanding.
Exactly. And what's fascinating here, really, is that we're not talking about illegal tax evasion. Not at all.
That's important.
It is. We're looking at these intricate, sometimes incredibly sophisticated legal ways of doing things. These aren't simple tips. They need expert help, what our sources call a global army of advisors. And crucially, they often depend entirely on where you are, the U.S., UK, India, offshore centers. It's a very specialized game. Yeah.
A specialized game, yes. So where do we start? Maybe with something really fundamental. How assets themselves are, well, handled. I heard it's almost like just holding wealth is a strategy, this phrase. Buy, borrow, die. Yeah, buy, borrow, die.
Right.
So the core idea, I think, is about unrealized gains. You see, things like stocks or real estate, you generally only pay tax on the profit when you actually sell them, right?
That's correct. Until you sell, the gain is unrealized.
So if you just hold on to assets that have gone way up in value, maybe for years, decades even, the wealth is there, maybe not liquid, but you're not paying tax on that growth year after year. The appreciation isn't taxed until you, well, realize the gain.
Precisely. Deferral is key.
Okay, but what if you need money? You can't spend stock certificates. That's where the borrow part comes in, I guess. Asset-based loans.
Exactly. Instead of selling those appreciated assets and triggering tax, you borrow money using your portfolio or property as collateral.
And borrowing money is an income, right? So no tax.
Correct. It's a loan, not income.
Yeah.
So you get liquidity, you can spend the borrowed money, but you haven't sold the underlying assets, so no capital gains tax is due at that point. It's a very, very common way for the wealthy to access cash from their wealth.
Okay. Buy, borrow, then die.
This sounds a bit grim, but I understand it's maybe the most powerful part for, like, family wealth, the step up in basis.
It is grim phrasing, but yes, it's incredibly powerful. When someone passes away and leaves assets to their heirs, the cost basis of those assets gets stepped up or reset
To what?
to the fair market value at the time of the owner's death. So imagine your parents bought stock for, say, $10 a share. And when you inherit it, it's worth $1,000 a share.
Okay.
Your new cost basis isn't $10, it's $1,000. Wow, so if I sell it the next day for $1,000.
You owe zero capital gains tax. That entire $990 of appreciation that happened during your parents' lifetime is effectively wiped out for tax purposes.
That is astonishing, really. No wonder it's key for generational wealth.
Absolutely. It's a massive benefit embedded in the tax code, certainly in the U.S. And speaking of assets, real estate is another big one, isn't it? It seems to come with its own set of tax advantages.
Yeah, seems like it.
Well, for starters, there's depreciation deductions. What's kind of interesting here is that even if a property is actually going up in market value, the tax rules often allow you to deduct a portion of the cost of the building, and sometimes equipment or even intangible things, over time.
Like wear and tear on paper.
Exactly. It's treated as if it's wearing out. And these deductions can offset other income you might have, reducing your overall tax bill,
Yeah.
even while the real-world value might be climbing.
Okay, that's one. What else? I've heard of 131 exchanges in the U.S.
Yes, 1031s, or like-kind exchanges. That's a really powerful tool specifically for investment properties in the U.S. It lets you sell one investment property and roll the proceeds into buying another like-kind property within a certain time frame.
And the point is?
You defer paying capital gains tax on the sale. You can keep doing this, rolling gains from one property to the next, potentially deferring that tax liability indefinitely, maybe even until death, where the step-up in basis could kick in again.
Wow, so you could potentially build a huge real estate portfolio without paying capital gains along the way.
Potentially, yes, if structured correctly under the rules. And then there's something called conservation easements. This is a bit different.
Why so?
It's where a landowner donates certain rights, usually the right to develop a piece of land, to a conservation group, keeping the land undeveloped.
So it's like a charitable donation.
It is treated as one. You get a potentially significant income tax deduction for the value of the rights you gave up, and it can also lower the value of the land for estate tax purposes later on. So it protects land and provides tax benefits.
It's really striking how many different angles there are. And you mentioned charitable giving there. That's another area that seems, well, maybe not just about philanthropy when you look closely.
Well, philanthropy is often the primary motive, but the tax advantages are certainly a significant factor and, frankly, an intended incentive in the tax code.
How does that work? Like giving appreciated assets?
Yes, that's a big one. Instead of selling stock that's gone way up, paying capital gains tax, and then donating the cash.
You donate the stock directly.
Exactly. If you donate the appreciated stock directly to a qualified charity, you generally avoid paying the capital gains tax on that appreciation, and you can often deduct the full fair market value of the stock from your income.
So a double benefit. Avoid tax on the gain, get a deduction.
Precisely. It's very efficient.
And then there are things like donor-advised funds, DAFs, and private foundations. These sound more complex.
They are a bit more structured. With a DAF, you contribute assets, cash, stock, whatever, to an account sponsored by a public charity. You get an immediate tax deduction for that contribution.
Okay, immediate deduction. But what happens to the money?
It sits in the day of count, potentially growing tax-free, and you, the donor, can then advise the sponsoring organization on which charities should receive grants from that fund over time. So you get the deduction now, but the actual payout to the end charity can happen later.
So you keep some control, or influence at least.
Influence, yes.
Yeah.
Private foundations offer even more control, but also come with more complex rules. As one source, I think it was a Reddit thread we saw, pointed out, they're tax exempt. They can pay reasonable salaries to family members for legitimate work for the foundation, and the family maintains control over grant decisions.
Right, that highlights the control aspect quite clearly. And what about charitable remainder trusts, CRTs?
CRTs are another tool. You transfer assets into a trust. The trust pays you, or someone else you name, an income stream for a set period or for life.
Okay, income back.
Yes. And when the trust term ends, whatever is left the remainder goes to a designated charity. The benefits. You can defer capital gains tax on assets put into the trust. You get a partial income tax deduction up front for the estimated charitable remainder value, and you get that income stream.
So it's like blending personal benefit with eventual charity, all wrapped in tax advantages.
That's a good way to put it. And if we sort of zoom out, many of these techniques, especially the trust-based ones, are really about long-term planning.
Yeah.
Transferring wealth, protecting it across generations.
Right, keeping it in the family, but maybe out of the taxman's immediate reach.
If we connect this to the bigger picture, yes, that's often the goal. Things like GRATs, grantor retained annuity trusts, or dynasty trusts are specifically designed for this.
Okay, great rest. How do they work, roughly?
Very roughly, you put assets into a trust and take back a fixed payment, an annuity, for a set number of years. If the assets in the trust grow faster than the legally set interest rate used for the annuity calculation.
Which is often quite low.
Often, yes. Then that excess growth passes to your beneficiaries, usually your children free of gift or estate tax. It's a way to transfer the appreciation.
I see. And dynasty trusts. They sound permanent.
They can be in some jurisdictions. They're designed to hold assets for multiple generations, sometimes even perpetually, avoiding estate taxes each time the wealth would normally pass down. It shields the assets generation after generation.
Wow. And family limited partnerships, FLPs, another tool in the box.
Yes, another structuring tool. A family can pool assets into an FLP. The older generation might retain control as general partners, but they can gift or sell limited partnership interest to the younger generation over time.
And the benefit.
Because those limited interests often lack control and aren't easily sellable, they can sometimes be valued at a discount for gift and estate tax purposes. So you're transferring the underlying asset value, but paying less tax on the transfer because of the discounted valuation.
Clever. Very clever. And you mentioned jurisdictions earlier. Are some places better for these long-term trusts, like South Dakota, Delaware?
Absolutely. South Dakota and Delaware have become very popular for establishing trusts, especially these ultra-permanent or dynasty trusts.
Why them?
They offer significant advantages, very strong privacy protections, favorable laws allowing trusts to last for extremely long periods, sometimes forever, and crucially, many of these trusts aren't subject to state income tax in those states, even if the beneficiaries live elsewhere. That combination is incredibly attractive for preserving wealth long term.
It really paints a picture of how the legal structure around wealth is almost as important as the wealth itself. This optimization applies to businesses too, right? Not just personal assets.
Definitely. How you structure your business can have massive tax implications.
Like using LLCs or S Corp. I hear those terms a lot.
Right. Limited liability companies,
Mm.
LLCs, and S corporations are often set up as pass-through entities. This means the business profits and losses aren't taxed at the company level.
They pass through to
That's-
the owners.
Exactly. They pass through to the owner's personal tax returns and are taxed at their individual rates.
Hmm.
This avoids the potential double taxation you can get with a traditional C corporation, where the corporation pays tax on profits and then shareholders pay tax again on dividends.
Ah, I see. And S Corp have some extra wrinkles with salary versus dividends.
Yes, with S corp, owners who work in the business must pay themselves a reasonable salary, which is subject to payroll taxes. But then additional profits can often be distributed as dividends, which generally aren't subject to self-employment taxes. So it can be a way to manage that specific tax burden.
Okay. But what about regular C Corp? Is there any advantage there? I heard something about arbitrage.
Well, sometimes yes. While C corp face that potential double tax, the corporate tax rate itself, especially after recent U.S. changes, is sometimes lower, say 21% federally in the U.S., than the top individual income tax rates.
So you pay the lower corporate rate first.
Right. Then the company can decide when and how to distribute profits to shareholders, perhaps strategically timing dividends or using other methods. It allows for a different kind of tax planning by keeping profits within the corporate structure at that potentially lower rate, at least for a time.
Interesting. And there's this other thing. Private placement life insurance. PPLI. That sounds niche.
It is quite sophisticated,
Yeah.
generally for very high net worth individuals. Think of it as a life insurance policy wrapper around an investment portfolio.
Okay.
The investments inside the PPLI policy can grow tax-free. And importantly, the policyholder can often take loans against the policy value, and those loans are typically not considered taxable income. So it provides tax-free growth and tax-free access to liquidity, similar in principle to borrowing against other assets, but within an insurance structure.
That's quite a tool. It seems like these strategies get pretty global too, especially for big companies. Profit shifting.
Well, absolutely. When you're dealing with multinational corporations or individuals with assets worldwide, the game becomes international. We see complex global profit-shifting strategies.
It's like the double Irish. I remember hearing about that.
Yes, the double Irish with the Dutch sandwich was a famous one, though rules have tightened up. These schemes basically involve routing profits, especially from intellectual property like patents or brand royalties, through subsidiaries in low-tax jurisdictions like Ireland, and then often onto even lower tax places like Bermuda or the Caymans.
To minimize the overall tax bill.
Drastically. By recognizing profits in places with near-zero tax rates, companies could significantly slash their worldwide tax burden. There are newer versions of these, base erosion and profit shifting, or BEPS schemes constantly evolving as rules change.
And tax inversions. What's that about?
That's where a company, often a U.S. one, effectively redomiciles its legal headquarters to a country with a lower corporate tax rate, like Ireland or the U.K., often by merging with or acquiring a smaller foreign company.
Even if most of their business is still in the U.S.
Often, yes. The operational HQ might stay put, but legally, they become, say, an Irish company to benefit from Ireland's lower corporate tax rates on their global income. It's a controversial move, basically changing your corporate passport for tax reasons.
It really underscores this idea of a wealth defense industry you mentioned earlier.
It does. Our sources point to this global network, lawyers, accountants, wealth managers who specialize in setting up these offshore entities, complex multi-jurisdictional trusts, and finding ways to navigate or maybe exploit the differences between national tax laws. It's their entire focus.
A global game indeed. Okay, let's shift gears slightly. What about more maybe tactical things, dealing with losses, or even just moving house?
Right, those are definitely part of the playbook too. For businesses, net operating losses, or NOLs, are important. If your business loses money one year,
Which happens.
of course, that loss often doesn't just disappear. It can typically be carried forward to offset profits in future years, reducing your tax bill when you eventually become profitable again. Some jurisdictions even allow carrybacks to offset past profits.
Smoothing things out tax-wise.
Exactly. And for investors, there's capital loss harvesting. This involves deliberately selling investments that have lost value.
Why sell losers?
to realize the capital loss. That loss can then be used to cancel out capital gains you might have realized from selling winners. And if your losses exceed your gains, you can often deduct a certain amount against your regular income too. It's about strategically using losses to lower your tax on gains.
Makes sense. And the moving house idea, relocation or town shifting.
It's maybe the most straightforward strategy, conceptually. You simply move your legal residence to a place with lower taxes or no income tax at all.
Like Florida or Texas in the U.S. or Monaco, Dubai.
Precisely. If you become a resident of a low-tax or no-tax jurisdiction, you can potentially save enormous amounts on income tax, capital gains tax, sometimes even estate taxes, depending on the specifics. Your physical address becomes a major tax planning tool.
Geography as tax strategy. Okay. Now, you mentioned some niche loopholes earlier that sounded, well, surprising. Can we unpack a few of those?
Sure. There are always these specific corners of the tax code. For example, intangible drilling costs, IDCs, in the oil and gas industry.
What are those?
Investors in oil and gas exploration can often deduct a large portion, sometimes up to 100% of the costs associated with drilling wells, the intangible costs in the very first year. It's a big upfront deduction designed to incentivize domestic energy production.
Okay, specific to that industry. What else? Opportunity zones.
Yes, that's a relatively recent U.S. initiative. Investors get tax breaks for putting capital gains into businesses or real estate projects located in designated low-income communities, these opportunity zones.
What kind of breaks?
You can defer tax on the initial capital gain you invest. If you hold the opportunity zone investment long enough, say 10 years, any appreciation on that investment can become completely tax-free. It's meant to drive investment into distressed areas, but it's a very attractive tax deal too.
Interesting mix of policy and tax planning. Now, here's where it gets really interesting for me. The yacht thing. A yacht as second home.
Seriously? Well, yes, it sounds a bit outrageous, but under certain conditions in the U.S., if a yacht has, say, sleeping quarters, a galley, a toilet, it can potentially qualify as a second home.
And if it does?
Then the interest paid on the loan used to buy the yacht might be deductible as mortgage interest, just like for a regular second home, up to certain limits. It requires careful documentation and meeting specific criteria, of course.
Okay. And private jets, how does that work? Private aircraft via corporations.
Similar principle, but usually framed as a business expense. If a corporation owns a private jet and can demonstrate that it's used primarily or even exclusively for legitimate business travel, flying executives to meetings, clients, remote sites.
Needs to be genuine business use.
Absolutely critical.
Yeah.
Then a significant portion of the cost, depreciation, fuel, maintenance, pilot salaries can potentially be deducted as business expenses by the corporation. It comes down to proving that business necessity over personal luxury.
It really does highlight the creativity, doesn't it? But all this happens within a bigger context, right? Laws change, politics shifts.
Constantly. The political and policy context is absolutely key. Tax laws are not static. They're always being debated and reformed.
Like those UK non-dom reforms we read about, affecting foreigners living in the UK.
Exactly. Recent changes and proposed future changes to the rules for non-domiciled residents in the UK have caused a lot of uncertainty and reportedly led some wealthy individuals to leave the country.
And now they're talking about ways to lure them back. A Britannia card?
There have been proposals floated, yes. It shows this international competition for wealthy individuals and the capital they bring. Countries adjust their tax rules to attract or retain them.
And in the U.S., it feels like tax law is always in flux.
It certainly is. There are ongoing debates about tax rates for high earners, corporate taxes, adjustments made during the Trump administration, potential changes under Biden, tax incentives get added, removed, modified. It keeps tax planners very busy just keeping up.
And globally, this idea of a global wealth tax, is that actually happening?
It's being seriously discussed, particularly at forums like the G20. Brazil has pushed for exploring a minimum tax on the world's billionaires, maybe around 2%.
But is there agreement?
Not really. Our sources suggest implementation faces huge hurdles, getting many different countries to agree on the details, how to value assets consistently, how to enforce it across borders. It's incredibly complex. So lots of talk, but major challenges remain.
This raises an important question, doesn't it, about fairness? And, well, can governments actually enforce the rules they make?
That's the flip side of the coin. Enforcement and backlash. Even with all these legal strategies, tax authorities are pushing back, and there's public pressure too.
Like crackdowns. You mentioned HMRC in the UK.
Yes, Her Majesty's Revenue and Customs, HMRC, actively investigates and challenges what it sees as abusive tax avoidance schemes. We saw the example of the jockey Frankie Dettori's case involving a disguised remuneration scheme. HMRC flagged it, fought it, and similar schemes were banned. It shows they're watching.
And the IRS in the U.S.
The IRS is also under pressure to increase scrutiny, particularly on high-income individuals and complex partnerships. Investigative reporting, like ProPublica's series based on leaked tax data, has really shown a light on how little tax some billionaires pay, fueling public debate and calls for stronger enforcement.
And this GAAR idea, General Anti-Avoidance Rules.
Right. Some countries, like India, have implemented GAR. These rules give tax authorities broader power to disregard transactions or structures if their main purpose seems to be just avoiding tax, even if they technically follow the letter of the law. It's looking at the substance over the form.
So it's a real cat and mouse game, it seems. After hearing all this, what stands out most to you, our listener? Okay, so just to wrap up what we've covered, it seems clear that wealthy individuals, and corporations too, use this really complex sort of layered system to legally pay less tax. It's not just one thing, is it? It's how they hold assets, the banks or trusts they use, which countries they operate in, the legal entities they choose, even how they handle charity. It's like a whole financial ecosystem built around tax efficiency.
That's a great way to put it, an ecosystem. And these strategies, they really depend on long-term vision, having these very sophisticated teams of advisors, top lawyers, accountants, wealth managers, and being able to navigate different countries' rules, what we call jurisdictional arbitrage. It's also about spotting loopholes, understanding the timing of legislation. And while, as we've stressed, much of this is legal, some of it definitely pushes boundaries in the public eye, and it is facing more scrutiny and potential reforms around the world.
So here's a final thought to leave you with. As tax rules keep changing, as global scrutiny gets tighter, how might this whole wealth defense landscape actually change in the next few decades? What does all this mean for how we think about fair taxation globally? It's this constant dance between the rules, the strategies, and what society finds acceptable. Definitely something to keep watching.